My name is Christopher Finlay. I'm the Executive Dean of the Faculty of the Professions, and it's my pleasure to welcome you to this Harcourt lecture this evening. Let me introduce the Vice-Chancellor who's going to introduce the speaker. Warren Bevington has joined us in the last couple of months as President of the University, was previously at the University of Melbourne. Thank you, Vice-Chancellor, for coming this evening.
Thank you, Christopher. Good evening, everyone. I'd first like to acknowledge the Kaurna people, the original custodians of the Adelaide claim to the land on which the University of Adelaide's campus of Terrace, White, now stand. The Harcourt Visiting Professorship was established by generous donation in recognition of 25 years of infectious enthusiasm and distinguished scholarship which Jeff Harcourt gave to the School of Economics. Each year, the endowment invites a global leader in the field of economics to share their knowledge and experience, not only with the students and staff, but also with the broader community. A particular welcome tonight to Professor Jeff Harcourt, after whom the lecture is named. Very glad you could be here for this occasion. Welcome also to the donors who helped establish the Harcourt lecture tonight. Here tonight are some of the most generous donors in Cavallic, John Hatch and Paul Van der Lee. The Harcourt Visiting Professorship enables staff in the School of Economics to interact with some of the leading academics around the world. And this is obviously of great importance for our staff and our students. This year's Harcourt Visiting Professor is the globally influential economist, Professor Avinash Dixit. Professor Dixit is the John J.F. Sherrerd 52 University Professor of Economics Emeritus at Princeton University. He's also a distinguished adjunct Professor of Economics at Lingnan University, Hong Kong, and a Senior Research Fellow at Nuffield College, Oxford. His research interests have included microeconomic theory, game theory, international trade, industrial organisation, growth and development theories, public economics, political economy and the new institutional economics. His books include co-authored works The Theory of International Trade, The Art of Strategy, Investment Under Uncertainty, Games of Strategy, and his book Lawlessness in Economics, Alternative Modes of Governance and the Making of Economic Policy, Transaction Cost Politics Perspective. He's also published numerous articles in professional journals and collected volumes. He was president of the Econometric Society in 2001 and of the American Economic Association in 2019. He was elected to the American Academy of Arts and Sciences in 2002, the National Academy of Sciences in 2005, and the American Philosophical Society in 2010, and was elected a corresponding fellow of the British Academy in 2006. The title of his lecture tonight is Foreign Direct Investment and Economic Governance. Colleagues and ladies and gentlemen, would you please make welcome Professor Avinash.
Thank you, Vice-Chancellor, Dean Finlay, distinguished guests, especially the Honoree Jeff Harcourt, who's a long-standing friend in the profession. Thank you, everyone, for coming. It's a real special pleasure to be able to honor Jeff Harcourt. We go back long ways to the days of the great capital controversies. I actually was rather late coming to the controversies and was not a very active participant, and have to say my sympathy was somewhat on the other side from Jeff. But I know personally, and I've heard from people involved on both sides, that from that side, Jeff was much the best. Not just in his arguments, but in the style. He carried on the controversy with real civility, generosity, and verve. He was just a pleasure to discuss economics and economists with, and indeed we spent a very pleasant hour today just after lunch doing exactly that. Now, my subject actually does involve capital, but it's not controversial, at least not quite in the same way. It's to do with foreign direct investment and economic governance. You all pretty much know what foreign direct investment is, although I'll point out problems with the data that will make you wonder whether you really know. But what's economic governance? This actually is a buzzword. People have been using it increasingly for more or less any kind of aspect of economic policy, and everybody uses it in his or her own way. I'm going to use it in my own way, so I'll tell you what I mean by economic governance. It's basically the whole system of rules, their making, their implementation, etc., that underpin markets by protecting property rights and enforcing contracts. And you can very easily see that a system of this kind, of institutions, of organizations, etc., is going to be absolutely essential for economic activity to function. If you didn't have protection of property rights, people would not go in for much capital accumulation. Things like establishing plant, installing equipment, improving land, etc., wouldn't get done if people who spend efforts in this were afraid that their property would then promptly be stolen. Any kind of modern economy needs a whole lot of production specialization. We have known that from Adam Smith. But to go in for production specialization, very often you have to invest in some specific assets that would become useless if your partner broke the contract. And therefore, the partner would have the temptation to threaten to break the contract in order to try and extract better terms from you once you're stuck with him. So if you're afraid of that, if you're afraid that contracts would not be enforced, you'd be afraid to go in for specialized investments and a whole lot of the kind of Smithian economies of scale, etc., benefits in the economy would not happen. Even ultimately in the simple kind of thing where goods or services are bought and sold, unless they're things of absolutely known quality and the payment is immediate, there are explicit or implicit contracts involved. And the supplier might renege on quality, supply a low quality good or service that would not be found out till later. The buyer might renege on payment when there are delayed terms. Again, people who are afraid that governance for their implicit or explicit contracts is not good enough would not go in for that. And pretty much any kind of advanced economic activity would just not happen, grind to a halt. So economic governance is absolutely essential. By the way, just to qualify, I'm not talking about corporate governance, the kind of problems that exist in the management of a company between upper-level managers and lower-level managers, managers and workers, or shareholders and management. Those kind of things I'm not talking about. I'm talking about relationships between two entities that are separate, two separate companies or companies and consumers, etc. Of course, the two are related because, as we know from the work of Ronald Coase, Oliver Williamson, etc., the definition of what constitutes a firm or what's taken inside a firm is itself dependent on the kind of governance that exists. So the two are related, but distinction can be usefully maintained. Where does governance come from? You naturally think government, and sure, all governments have their systems for making commercial law, adjudicating disputes, enforcing law, etc., etc. So there's a formal system of state governance, but it always coexists with a whole lot of social institutions, networks of traders, business associations, norms of conduct, sanctions for violating those norms. So businessmen would not deal with somebody who they know to be a cheat, would ostracize, and sometimes that penalty is more serious than what the government's contract system might inflict. These formal and informal systems, the state system and the network type system, coexist in all countries. And both of them are variable quality. Broadly speaking, it's true that the more developed an economy, the greater the proportion of transactions that will be taken care of by the state system. But even in very advanced economies, the informal social systems continue to play quite an important role. However, even when you put the two together, governance is almost never perfect in any country. And in particular, the formal system of governance often can be quite poor in less developed countries and countries that are transitioning from socialism, where even with the kind of best interpretation, they don't really have the experience of how this sort of system might operate. They have a lot of learning to do by the way of how courts might operate, etc. Courts might be biased so that the foreign firm that's trying to enforce a contract in a country might be afraid that its courts would favor locals or near locals. So an interesting example recently was the case between Apple and Samsung, which was one case was fought in the US where Apple won handsomely, and another similar case was fought in Japan where Samsung got the better end of the deal. Sometimes the government or its agents themselves threaten property, violate contracts, etc. And when you think of this happening, you naturally think of corruption. But that's not the only problem. Maybe sometimes governments in their bid for re-election find it profitable to cater to kind of xenophobic sentiments in the country and try and beat up on foreigners. Or one government gave you a special kind of deal for your investment. There's an election, the other side comes in and says, no, no, we are not going to honor that. So there are all kinds of problems getting even the governments to honor their contracts or property protection promises. This then creates a problem for any kind of foreign transaction, and especially for foreign direct investment, more so than for kind of ordinary commercial trade, for two reasons. Investment involves basically a stock. You build a plant, which will then go on producing for a whole sequence of years. That's quite valuable, much more valuable than the trade flow that might take place over 3 months or a year. If that gets threatened, you just stop trading. Whereas if your plant gets expropriated, you have lost a whole big capital sum. Secondly, investments usually involve less repeated interaction. So if trade is going on for 5 years, there's 20 quarters worth of repetition going on. Whereas a firm might establish just one plant that will then run for the whole 5 years. And it's a standard kind of thing that repetition is very important in sustaining honest dealings if there isn't an outside enforcement system. So with less repetition, investment is rather more at risk than trade would be. And what I want to do is trace exactly this kind of connection between imperfection of governance and foreign direct investment and its various implications. Let me first of all give you a little bit of more precise quantitative idea of economic governance. Qualitatively, the idea is clear. But it turns out that the World Bank produces 6 measures of governance quality. For each of them, they've got 212 countries, and they rank them from worst to best and spread them along the spectrum from 0 to 100, 0 being the very worst, 100 being the very best. what I've done is to select 3 of those measures that seem most directly related to my concept of economic governance. And they're the quality of regulation, how good is the rule of law, and corruption. 3 that I left out of the World Bank 6 are somewhat more political. One is voice and accountability. Second is political stability and absence of violence. And the third is some kind of a general thing called government effectiveness, which seems to do with quality of civil service, et cetera, et cetera. Now, those surely have something to do with economic governance. Actually, things would not change very much if I had included them. But anyway, the 3 that seem most direct concern to me I used. And I took averages of the World Bank's rankings over 3 years, and then also averaged them over the 3 measures I'm taking. And here's the result. The very worst country is Somalia, which is very close to 0. Afghanistan is pretty bad. Then a whole bunch of kind of not so good countries come in, Nigeria, Pakistan, Russia, etc., where if you ever had occasion to do business, you know that you need to be very, very careful. Then number of middling countries. There's some ups and downs, actually. So Venezuela used to be up quite a bit in previous years until Chavez started threatening expropriation and contracts became difficult to enforce, all that kind of thing. Argentina used to be higher again until kind of nationalistic politicians got in. Then there's a whole lot of middling countries, China, Egypt, India, etc. And then number of advanced countries are actually very good. Most of the countries that we think of are in the high 80s or 90s. People here, I'm sure, will be pleased to see that Australia beats America quite handily. Not surprisingly, the best are the Scandinavian countries. And within them, there's kind of little bits of differences which may be quite accidental, but Denmark came out the top. So things have changed since Shakespeare's time, and now there's nothing rotten in the state of Denmark. So you can criticize this measure, all of these measures, and the way I've used them quite a bit. You can go into detail. But I think you'll agree that broadly, this makes quite good sense. So if people had asked you, where is governance good and where is governance not so good, you would have come up with some kind of an ordering that's not too different from this. So it's not a kind of vacuous concept. You can give it reasonably good quantitative measures also. So what happens to foreign direct investment in countries with weak governance? Turns out they actually get quite a lot, despite all the difficulties that I mentioned. Now, I've got here a table from UNCTAD, which is, I've adapted this from UNCTAD tables. A good set of data on investment in countries. Oh, by the way, I should have said, I've got rankings like this, ratings like this for all 212 countries. So in Q&A or afterward, if people want to find out where their particular country, Canada or something that's not listed here resides, Kazakhstan, I can tell you. Anyway, so what I did here was to take 5-year averages of inflows of FDI added up for all the countries of the world. So there's world total in millions of dollars. So this was 158 billion American billion in 86 to 90 annual average, till it's grown about 10-fold over 20 years. So, of which this much went to developing countries, those are the percentages, and this much went to socialist transition economies, and again, percentages. Now, I want to look at inflow of FDI into countries with weak governance. Developing countries and transition economies are not the entire exact coincident category with weak governance, But there's reasonable correlation, and that's the basis on which data are available. It would take too long for me to actually do anything with my kind of ranking and country by country inflows. But again, you see that in these categories of countries, the percentage of FDI for the whole world that they get is very substantial and rising, with maybe a little dip. This probably has to do with the East Asian crisis, but gone up to about a third or more into developing countries. So that's quite substantial. There must be something going on that enables investors to get around problems of weak governance, and I'll say a little bit more about that. I should, by the way, also say that there are a lot of problems with the quality of data. So what constitutes FDI as opposed to just buying shares in a foreign company, a portfolio investment? And the answer usually taken is, do you have some measure of control? And the definition given is, if you have more than 10% equity stake in a company, you're supposed to exercise some control, and therefore it's FDI, less than 10% not. So that's totally arbitrary. Why 10%? Why not 50%? You can question all those kind of things. There's a distinction between actually constructing a new plant or new machinery, what's called greenfield investment, versus buying an existing plant or company, that's mergers and acquisitions. The curious classes of phenomena that are called things like round tripping and transshipping. So you have a division, a multinational company somewhere else, you park the profits there and then invest back in your own country. That would then qualify as foreign direct investment, maybe for tax reasons, whatever. You channel the investment through a third country. Hong Kong and various other countries importantly play that role, and we'll see some reasons why. Curiously, the home country of a company is where its listing is. So if you change a listing, what might have been investment in the same country, not foreign, suddenly becomes foreign. And that happened when some South African mining or diamond companies changed their listings to London. Investment sometimes involves kind of big one-off projects, and a big one-off project will suddenly show up as a big blip. And if you don't know the details, you'll wonder what happened. So there are a whole lot of problems, but this is the kind of data we have. Maybe taking 5-year averages gets around some of those issues, but that's the best one can do. Okay, so how can countries attract FDI even if they've got poor governance? And one thing is that the firms that are investing and their partners in the host country or the governments of the host country before the fact have every incentive to try and get into a deal that will be enforced, because otherwise they'll just be leaving money on the table. They can try to make arrangements that will stick, and they do try. So they might choose a form of transaction that is relatively proof against the kind of governance problems. So the firm might have a wholly owned subsidiary in the foreign country, where it then just gives orders to the managers basically, rather than have any kind of arm's length contract that may or may not get enforced. Something I've left out of here, but they can enter into a contract that stipulates that any disputes will be heard in an international arbitration court that is separate from both the country of the firm and the host country of the investment, and they may rely on that rather more. They can use an intermediary, a local partner who's got long-term relationships both with the firm doing the investment and the country in which the investment is taking place. And big houses like Rothschilds or Morgans played exactly this kind of a role in the 19th and the early 20th centuries, Morgans between Europe and America, Rothschilds between various European countries, and more recently, post-World War II, Hong Kong played exactly this kind of a role between Western investors and Chinese manufacturing. I'll say a little bit more about that later. The host country might have ways of making a credible commitment that it will not expropriate the investment. And those of you who've read Schelling know that one way of doing this is to give a hostage. So if the host country has some assets in the country from which the investment is coming, those assets will be subject to countersuit or seizure if it tries to seize the investment. And Venezuela, for example, was able to attract investment from America despite bad governance, because it had a company retailing gas, petrol in America, Citgo, that would have been subject to seizure in exactly this kind of way. Many countries have entered into bilateral investment treaties called BITs, which specify that the country will protect the foreign firm's property rights coming from the partner signatory country. The direct effectiveness of these things is rather limited, because the host country has various layers of government, and you might kind of enter into a guarantee from the central government of the country, only to find that a local government suddenly taxes your investment or puts obstacles in the path of taking away the profits, all that kind of thing. However, people who've studied this, there's a lot of literature in law on this, think that the BITs are actually giving foreign investors too much protection. They're even being protected against what should be normal changes. Everybody knows that there's a risk that the corporate tax rate may change in the next budget for macroeconomic reasons, etc. But BITs sometimes protect foreign investors from those kind of changes as well, whereas they should not. So the debate on whether BITs are on the whole a good thing is an ongoing one, but that's also one of these ways in which weakness of governance can be gotten around. Let me try and relate this a little bit to the way in which economists have thought about foreign direct investment. And here is not much of a caricature, but you read economists' discussion of FDI, and you'll find that they're almost talking about investment coming from the north, in quotation marks, and going to other northern countries or to southern countries. North and south, I should emphasize, particularly speaking here, are directions on a map of economic development, not geographic ones. So in this sense, Russia is south and Australia is north. South Korea is north and North Korea is way, way, way south, maybe near the South Pole. So when I speak of south as having poor governance, does any FDI come out south, etc., not meant to apply to you. Okay, so the standard story is that the multinational corporation, MNC, comes from the north. And its main advantage is that it's got R&D, better technology, better management. After all, their managers are MBAs from Harvard, right? So and the problem with supplying technology or management in an arm's length way is that various problems of information make it really difficult to write contracts. So you license your innovation to a local firm, say, for royalties that will get you so many cents or so many dollars per item that they produce, you may not be able to keep track of the number of items they're producing. They may produce too many and, in fact, start to export some back to your country. So that's difficult. Management is similarly difficult because it's really very difficult to identify the contribution of a manager, to pay the manager in something commensurate, marginal product, as the economists would say. So usually these kind of things have to be packaged into something else so that the fee that you get for supplying technology or management is coming as a larger part of something. And that can be done by FDI, where basically you get the whole residual profit of the company after paying for labor and materials, and part of what you get is returned to your R&D or management. The South, the host country or the destination country, usually chosen because it's got some kind of a cost advantage, low labor, etc. That's the kind of standard story in theories of FDI. And that may also be, for various reasons, be non-contractable. And then you take into account what can be contracted, what kind of costs of transacting are, and choose the optimal mode, whether FDI or licensing or just making at home and exporting, etc. And this is variously called the eclectic theory or the ownership licensing, etc. I forget what the things stand for always, but the OLI type theory of FDI. This whole thing is shot full of acronyms and difficult to remember which is which in a broad sense you can think of as Williamson's transaction cost economics applied to foreign direct investment, but actually it was developed in the context of FDI independently. And those people simply didn't realize that it had such kind of broad applicability as Williamson later developed in the industrial organization context. And these were people like Stephen Heimer, Dunning, Dick Caves. And recent work in international trade theory, a number of people who do that kind of thing here would have read papers by Jim Markuson, who's actually visiting here right now. Grossman and Helpman, Nunn, all those kind of things are developments of this kind of theory, broadly kind of north to south FDI. Contrast that theory with the FDI you read about in the news, and it's completely different. It's actually all about firms from China and India and Brazil and whatnot making acquisitions, quite a lot in the north. Sometimes they actually turn around these companies and get them to perform a lot better than the original northern owners or managers were doing. Tata's running Jaguar for quite a while is an example, and some other examples as well. So the theory, and at least what you read in the news, stands in quite sharp contrast, and we should be figuring out, these are just examples. How important are they? And if, on the whole, FDI coming out of the South is an important phenomenon, how can we explain it? Can the same kind of theory that I sketched on the last page, or some adaptation of it, help explain it? Or do we need some other kinds of theories? So let's get an idea of the magnitude of FDI flows from the South. So this table is just an obverse, outflows of FDI, outflows for the whole world, outflows from developing countries, magnitudes and percentages, outflows from transition economies, magnitudes and percentages. By the way, for the world as a whole, inflows don't equal outflows. And that's usually various kinds of accounting features, kind of end of year or the way the data are kept, all that kind of thing. It's not as if some investment is going to Mars or coming from Alpha Centauri or whatever. So again, quite a substantial and increasing percentage of worldwide investment outflows are coming from developing countries. And much smaller. Actually, for transition economies, there's nothing before 1990 anyway, because there pretty much weren't any. But that's also increasing. There are southern multinationals that are investing both in other South countries and in northern countries. What are kind of some facts about them? Here are slightly differently put numbers. Now we have got some stocks as well. So this is the whole annual issue of UNCTAD's World Investment Review in 2006 that looked at investment coming from the South. It's time they did another whole one to update a lot of these numbers, but this is the latest available at this scale. So their data come from 2005, and in that, 17% of the world's total outflow came from the South, and 13% of the world's total stock was owned by South. So with the flow greater than the stock, that means that the flow was increasing. If you just look at the numbers of multinational corporations, actually this is a huge number, but some are really tiny. But that number is 26% of the total number of multinational corporations worldwide recognized as such. Multinationals means having FDI presence in more than one country. And since this number, the fraction of multinational numbers that are southern, is much bigger than either the stock or the flow, that means that they're much smaller. Some kind of specific regional things, outflow coming from part of Asia running roughly from kind of South Korea, coast of China, Vietnam, Thailand, etc. I kind of just coined the name Asian arc for that. And if that name sticks, remember you heard it here first. So those outflows in 2005 were 68 billion. Outflows from Eastern Europe, 15 billion, most of them from Russia, then going usually into other East European countries. Quite substantial numbers. Similar kind of thing asking what proportion of investment in developed countries was coming from other developed countries, and almost all of it. So although you see some prominent examples like Tata and Lenovo and so on, they account for only a small part of the investment going into the north. Conversely, into the Asian arc, coming from other less developed countries, almost 2/3. So there is a lot of regional concentration. And also there is intra-regional concentration, Asia to Asia, Latin America to Latin America, East Europe and Russia within itself, etc. So on the whole, from all of this, so I conclude that this is a pretty substantial phenomenon. We should study it. We should ask whether the same kind of theories can explain it or whether we need something else, etc. And I propose to do just a little bit of that in the rest of the talk. Actually, the existence of multinationals coming from the South was recognized very early. And as early as 1983, two quite influential books were published, one by Theodore Wells, Harvard Business School professor, and the other Sanjay Lal, and a number of co-authors who came from India and various other countries. And culling broad tendencies from their books, they find that those multinationals are smaller, as we saw. Their technologies and their management are better adapted to the local conditions than are those of multinationals investing in the same countries but coming from the north. Likewise, the southern MNCs have either already got from their previous experience in their own country or have developed better skills to manage the kind of low-skilled labor forces that they find. And I'll give an example of that in just a little while. They're more likely to engage in joint ventures with local partners. Again, I'll come back to this. And they're more likely to engage in bribery of local officials. Again, I'll come back to this. For quite a while, their sectoral composition was very concentrated in resource and extractive things, but that's been growing quite a lot. So those are kind of broad tendencies that are observed. And Wells and Lal and others also gave various explanations for this. And I mean all of these to be operating together. Economists very often have a tendency to regard explanations as competing. Is this theory true and all others false? Whereas usually 3 or 4 different things, or maybe a dozen different things are operating simultaneously, and we should be asking, is this 8% or 15% or what have you? So I don't mean any of these to be mutually exclusive. I mean all of them operate in various measures. Sometimes in their own countries, the governance was pretty poor and they did not find enough profitable, safe opportunities to invest in their own countries and went elsewhere. This was especially relevant for Indian family-owned firms in the 70s and 80s, where under the licensing Raj, they had a lot of accumulated profits. They were benefiting from being incumbents in the licensing Raj, but they couldn't reinvest those profits at home because, again, problems of licensing and problems of poor governance. They thought it more profitable to invest in kind of surrounding areas, the Middle East, East Africa, etc., etc. And secondly, they are sometimes welcomed or even invited to do so by governments in those countries who preferred kind of friendly, other suppressed third world people rather than the nasty colonial powers to be investors in them. Wells and Lal both mentioned both of these. And then there are a number of others. They might use FDI to acquire modern technology. And that, of course, is relevant for a lot of south to north investment. Or acquire natural resources and rights to land, including arable land. A fair amount of Chinese investment in Africa can be explained like that. And their governments, the Chinese government, the Indian government, very often subsidize FDI, particularly into northern countries, precisely to acquire technology for national benefit. Now, for non-economists among you, this is kind of obvious. There is a national benefit, so obviously the government should subsidize. Economists will immediately say, no, be a little bit more careful, because after all, the firms that are doing the investment are getting that technology and they'll profit from it. Don't they already have the right incentive to make that investment? Why do they need subsidy? Of course, they'll be happy to claim that they need the subsidy and have the government give it to them, but should the government? And economists will say that the government subsidy on top of the profit they're getting is justified only if there is some spillover benefit and externality, as economists call it, from their acquisition of this technology that they cannot capture in their own profit. And there may well be, but it's just to emphasize to non-economists that a lot of arguments for government intervention, etc., need somewhat more sophisticated arguments than merely that it carries that activity carries some benefit. What I want to do is to offer an additional hypothesis, and again I emphasize additional, not meant to replace any of the existing ones, related specifically to the theme of economic governance. And the idea is that quite apart from the kind of information problems that create non-contractibility that Williamson, Heimer, and company emphasized with regard to technology and management, poor governance itself creates a problem of non-contractibility in the sense you might write a contract, but it's not going to be enforced and maybe reneged on. Southern companies are used to dealing with this kind of problem in their own country, and the idea is that that will give them an advantage, a step ahead, when they invest in other countries that also have bad governance. Their technology might be better adapted to dealing with bad governance. So if there is bad governance and you can, for example, dismiss workers when you later on find their performance to be poor, you've got to monitor them all the time. And they're used to doing that, whereas northern firms might not be. I'll give a specific example. That's the kind of aspect, one aspect of managing low-skill workers where southern MNEs have greater competence. They know the importance of developing contacts, developing relationships, and doing so with local partners, with government officials, etc., to navigate all the regulatory obstacles. They have experience of doing exactly the same. So when India's license Raj was abolished in 1991, some of my cousins who were in business there told me that the big difference that that made was that they no longer had to spend half their time waiting in cabinet ministers' outside offices. So they know the importance of doing that where there are licensing restrictions. Americans barge into a country and expect to start doing business right away. And when they are taken for dinners by Japanese or what have you hosts for 3 months and drink a lot and no business is resulting, they get very impatient, not realizing that that kind of exploration of the other's personality, getting to know them really well, etc., is important for developing the kind of relationship on the basis of which, on the trust of which, you will later decide to do business. They're more used to bribery, and they're less constrained by their own country's laws. A lot of clean Western countries have laws that forbid their business people from giving bribes to even foreign government officials. But more than that, bribery is a skilled occupation. You don't barge up to an official and say, how much do you want? First of all, he might be suspicious that you will inform on him. You might be suspicious that he'll promptly get you arrested. You need to develop a relationship. You need to develop a kind of language by which you explore whether they're willing to engage in that kind of a transaction. And these people, although they may not be aware, the people from southern MNEs who go into these, of the exact procedures that prevail in the country in which they're proposing to go, they know that something has got to be done. And they're willing to learn and do it. That's why they're more likely to use local partners. And they're more likely to have local partners available through very often their ethnic and linguistic networks, which is again part of the reason why there is intra-regional concentration of investment. Of course, northern countries might have better technology in some way, etc., etc. They have other advantages that are usually offered, and you've got to set those advantages against these advantages that southern MNEs have in navigating regulatory and governance obstacles to find out who will be the winner in one particular investment. But we need to recognize that all these advantages of southern firms in coping with bad governance will play a role in their outward FDI. There's a fair bit of evidence supporting this hypothesis. Some comes from anecdotes or case studies. So the role of Chinese ethnic networks has been studied quite a lot. By the way, I've given these references which are in the paper, which should be available one way or the other on the website. It's Florence European University Institute kind of internal publication. So those of you who are interested can follow that up. Second example is the way in which Western investors into China used Hong Kong as an intermediary. Li and Lian convincingly demonstrate how the Hong Kong intermediaries used a formal governance system in Hong Kong in dealing with the Western investors, but a relational guanxi-based system in dealing with manufacturers in China to strike deals that the Western investors could not directly have done. Culture, in the sense, in this case, of communist planning type operations came of use for some Chinese firms, Huawei and TCL. When they're looking to invest in Russia, Vietnam, they chose those because they could deal better with the officials there. They knew the similar kind of procedure. And very interestingly, a Yale PhD thesis that was completed last year compared textile firms in China coming from Japan on the one hand and Britain on the other. And they found that the Japanese firms in China were 70% more productive than the British firms in China, even though British firms in Britain were more productive than Japanese firms in Japan. And the way in which this happened, he argues, is that the Japanese used methods for managing Chinese workers at that time that were much more suitable, needed much more intensive monitoring. They needed to use their own foremen, etc., supervisors, to prevent collusion between foremen and workers in China. They knew the kind of problems that would arise if they didn't do that, and did that, whereas the British found out only when they weren't doing so well. There's some statistical econometric work. I mentioned just a couple. There are two papers that do cross-country regressions and find that having bad governance, other things equal, does hurt the inflow of FDI you get. But it hurts less. The coefficient is less negative if the investment comes from a country which also has bad governance. Then what are investors worried about? Turns out that in East and Southeast Asia, the within region investors were less worried by country risk. They were much more motivated by economic fundamentals. And the interpretation is that they knew how to cope with the country risk, at least so far as it came, because of governance deficiencies. So there's a fair bit of evidence. What about theory? Now, I have to apologize to those of you who are not economists. The rules of my profession, the norms, sanctions, etc., require me to display at least one equation and at least one graph. Otherwise, they'll court-martial me, strip my epaulets off, etc. So I'll just flash this past you, and those of you who are interested can follow it up. So I've adopted a model in which there are costs of either directly investing or using a local partner. And the costs of directly investing are you may not be able to cope so well with governance, or your technology may be too sophisticated and you're not able to manage locally. So there are these two variables. R is an inverse measure of governance quality. Think of R standing for rottenness and T standing for technology. And the problem with using a local partner is that they will allow you to reduce these costs. They know how to cope with bad governance in that country or help you adapt your technology more quickly. But then they might steal your technology. So you put all these things together, and turns out that as in relation to R and T, this space splits into 3 regions. If both R and T are high, your technology is inappropriately sophisticated and governance is very bad, best to stay out. In this lower region, where your technology is not so sophisticated that stealing is less likely and the governance is good enough again that stealing is less likely, you go with a joint venture partner. And if the governance is good and your technology is fairly sophisticated, you can go as vertical integration, wholly owned subsidiary, do it directly on your own. And what you can then do is compare what a northern firm would do versus what a southern firm would do. So in a country like this, a northern firm with this technology would stay out, whereas a southern firm that's got a more better adapted technology would go in. You can do a whole lot of these classifications, comparisons, etc., that start to give you testable hypotheses. Then you do what economists love to do, shift those curves around as some other variable changes. So I'll just leave that for economists and sum up that here is an important and rather distinct from the usual way in which FDI is thought about phenomenon of FDI coming from southern countries, particularly to other southern countries. And it can be thought of in terms of the advantages southern firms have of coping with bad governance, offers possible policy implications, so emphasizes for investors from the north the importance of locating local networks, local partners, etc., to some extent coping with the need for bribery. They do use things like facilitators, etc., but then that just shifts the problem one level. What if the facilitator cheats you? You have no recourse against that. So their governments should press to try and get better treaties, maybe of the bilateral investment kind, although those have their own problems. And of course, southern countries and their firms should actually explicitly recognize and strategize to use the advantages they've got. I mean, they've got a whole lot of other things stacked against them. They need to use every advantage they've got. And then for the economists among you, this is a great research opportunity to do more empirical research, look for better data, etc., things in which I don't really have any qualifications or skills at all. So that's an open subject for any of you to take away and run with. So thank you very much for coming and listening. So we have time for some questions.
In the interest of time, we have opportunity for perhaps 3 or 4 questions. Would you like to take them directly?
Yeah, absolutely. So, usual question, who will go first?
One thing that seems striking was you didn't distinguish between different sectors of the economy. So when we look at, say, transition economies, a lot of the foreign investment is in energy and minerals, and the northern companies seem to have learned pretty well how to deal with corruption because they have to go to some awful places to get their oil. But the southern countries don't kick out very often ExxonMobil because they've got the technology. So does it depend a bit, your theory, on what kind of sector you're looking at? You seem to be looking at a labor-intensive sector, basically.
That's probably right. And in fact, extractive investments face a whole lot of other problems. So there's the concept of the obsolescing bargain, where the country gives upfront advantages, various tax breaks, payments, etc., knowing full well that a time is going to come when it will be expropriated in one form or the other, directly or indirectly. That certainly deserves separate treatment. But I would not be surprised if even there, Chinese firms, for example, might have an advantage over ExxonMobil in dealing with the countries and their firms, and may also be, it seems quite frankly, kind of just impressionistically, that a lot of African governments are afraid of China in the way that they're not afraid of America or India or anybody else.
Did you take into account market structures of multinationals, whether they're tending towards large competing oligopolies, or there's a tendency for a monopolist to dominate as far as foreign direct investment is concerned?
No, that aspect I've not gotten to at all. But worth looking at. It kind of will work a little bit differently, I'm sure, specifically in the context of southern firms investing. They're not that large. Maybe the market structure will be less monopolistic, less oligopolistic than in the case of some Western multinationals in some sector. But no, I've not gotten that so far at all. Another research opportunity.
Yeah. Well, the reason why I ask is that my colleague Peter Nolan, we tested the predictions of Kurt Rothschild on the one hand and Steve Heimer on the other. And Steve Heimer said the world would end up with giant monopolies, and Rothschild said no, it would be giant multinational oligopolies. And from the huge case study set that Peter has, we thought that Rothschild was probably right.
That makes sense.
Yeah.
So how southern multinationals will end up is quite another question.
Maybe a provocative question. What are the implications of this for how Harvard should teach its MBA students?
These days, American business schools are at least making some deliberate effort at teaching business ethics, etc. May well end up being a disadvantage when they're investing in many of these countries. But I'm not going to say that they should tell their students, hey, look, when in India, do as Indians do.
My question probably follows on a bit from this and also Richard's. You mentioned that southern countries have a comparative advantage in investing in other southern countries because they know how to get around the rules, they know how bribery works. We've seen that southern investment explode in the recent decades. Would that suggest that corporate governance could be decreasing as a result of that?
Corporate, in the sense of governance within the corporation. So you're saying they deal in this kind of a dirty atmosphere, and that dirt is their own internal. That's possible, but on the other hand, it may well be that it actually increases the need for better corporate governance in the following sense. Let's suppose your middle managers are going there and dealing with the local officials, giving bribes, etc. Then they've got an enormous opportunity to pocket some of the money for themselves, right? And the top management, realizing this, should, one way or the other, try and make redoubled efforts to monitor the middle managers, to try and make sure that they are not robbing the company in the process. It's a little bit like managing a restaurant, where you need a lot of close supervision because the employees have so many opportunities to rob you blind.
If we consider that bribery and all these corruptions are negative to welfare in general, and this rolling south of investments to another southern country suggests that actually they are promoting it, and what does that imply?
So investment that otherwise would not have taken place is facilitated by the bribes. It depends on what view you take of that, the kind of harmful things happening elsewhere. I'm actually in this situation being, if you like, completely non-judgmental. Here's the situation, how do you deal with it? Or how do you understand the way people are already dealing with it? But what usually happens is that there is often a kind of feedback system, where as the economy grows and people get more affluent, one of the kind of things they start to demand more and more is cleaner government, not just in dealing with companies, but in their own lives. Whether, for example, you need to pay a bribe to get a landline telephone. That used to be perfectly common when I was young in Bombay. And but that kind of thing has gone down substantially, and partly it's because the people, as they get more affluent, don't want to stand for that kind of thing. So it may well be that this system will be self-defeating if it kind of promotes growth. That growth itself will bring about decline of the corrupt system, and let's at least hope so.
Well, as Dixit, that presentation was erudite, the knowledge of the literature was on display, the originality of the concepts about sourcing so much FDI from developing countries was absolutely fascinating, and also on display was your humour. I'm sure all our students were interested to hear that bribery is a skilled occupation and to learn that Australia is in the north. So thank you so much for this, and would you all join me in thanking